What is an ETF? Simply explained for beginners. Let's dive into one of the most popular investment tools out there, exchange-traded funds, or ETFs. You've probably heard the term tossed around, invest in ETFs. But what asterisk are they really? And why are they so common? This video breaks down ETFs in a way that's easy to understand, even if you're just starting your investing journey. We'll cover everything from how they work to different types and how they can fit into your portfolio. Understanding the basics, what is an ETF? An ETF, or exchange-traded fund, is essentially a basket of securities, stocks, bonds, commodities, or even currencies that trades on stock exchanges just like individual stocks. Think of it as a prepackaged collection of investments designed to track a specific index, sector, commodity, or investment strategy. Instead of buying shares in one company, like you would with an individual stock, you're buying a piece of the entire group represented by that ETF. How ETFs work, a step-by-step explanation. 1. Creation. An ETF provider like Vanguard, BlackRock, iShares, or State Street creates an ETF. They decide what the ETF will track, for example, the S&P 500 index, which represents the 500 largest companies in the US. 2. Basket of assets. The ETF provider then buys a large quantity of the assets that make up the chosen index or strategy. So if it's tracking the S&P 500, they buy shares of all 500 companies proportionally to their weighting within the index. 3. Shares issued. The ETF provider creates and sells shares of the ETF to investors. These shares represent a proportional ownership stake in the underlying assets. 4. Trading on exchanges. Just like regular stocks, these ETF shares are listed on major stock exchanges, the New York Stock Exchange, NYSE, or NASDAQ. This means you can buy and sell them throughout the trading day at market prices, just like any other stock. 5. Tracking the index. The ETF's value fluctuates based on the performance of the assets it holds. Because it's tracking an index, its goal is to mirror that index's returns. Why invest in ETFs? Key advantages. Diversification. This is arguably the biggest benefit. By investing in a single ETF, you instantly diversify your portfolio across many different companies or asset classes. If one company performs poorly, it has less impact on your overall investment than if you had invested solely in that company. This reduces risk, a core principle of sound investing. Let's say you buy an S&P 500 ETF. You own a tiny piece of Apple, Google, Amazon, Microsoft, and every other company in the top 500. Low-cost ETFs generally have lower expense ratios, annual fees, than actively managed mutual funds. This is because they are passively managed, meaning they simply track an index rather than having a fund manager trying to pick winning stocks. Lower costs mean more of your investment returns stay with you. For example, the Vanguard S&P 500 ETF, VOO, has an expense ratio of just 0.03%, which is incredibly low. Liquidity. ETFs trade on exchanges like stocks, so they're highly liquid, meaning you can buy or sell them quickly and easily during trading hours. Transparency. You always know exactly what the ETF holds because its holdings are typically disclosed daily. This transparency builds trust and allows you to understand your investment. Tax efficiency. ETFs tend to be more tax efficient than actively managed mutual funds due to their structure and how they handle capital gains distributions. Types of ETFs. A breakdown. ETFs come in a huge variety, each designed to track a specific market segment or strategy. Here are some common types. 1. Index ETFs. These track a broad market index like the S&P 500 SPY, the NASDAQ 100, QQQ, or the Russell 2000, IWM. They provide exposure to the overall performance of that index. 2. Sector ETFs. These focus on specific industries, such as technology, XLK, healthcare, XLV, energy, XLE, or financials, XLF. This allows you to target growth in particular sectors of the economy. 3. Bond ETFs. Asterisk, these invest in a portfolio of bonds and are categorized by maturity, short-term, intermediate-term, long-term, and credit quality, investment grade, high yield. Examples include iShares Core US Aggregate Bond ETF, AGG, or Vanguard Total Bond Market ETF, BND. 4. Commodity ETFs. Asterisk, these track the price of commodities like gold, GLD, silver, SLV, oil, USO, or agricultural products. 5. Currency ETFs. Asterisk, these track the value of different currencies, allowing you to gain exposure to international markets. 6. Thematic ETFs. Asterisk, these focus on specific trends or themes, such as robotics and automation, ROBO, clean energy, ICLN, or artificial intelligence, BOTZ. ETF versus mutual funds. What's the difference? While both ETFs and mutual funds are investment vehicles that pool money from multiple investors to invest in a portfolio of assets, there are key differences. Feature: ETF, mutual fund. Trading: asterisk, traded on exchanges like stocks, bought and sold directly from the fund. Pricing: asterisk, price fluctuates throughout the day, priced once per day after market close. Expense ratios: generally lower, can be higher. Minimum investment: asterisk, typically low. You can buy one share, often have minimum investment requirements. Tax efficiency: asterisk, generally more tax efficient, can generate taxable distributions. Important considerations before investing in ETFs: asterisk. Expense ratios: asterisk, always check the ETF's expense ratio. Even a small difference in fees can significantly impact your returns over time. Tracking error: asterisk, an ETF's performance might not perfectly match its underlying index due to tracking error. This is usually minimal for popular ETFs, but it's something to be aware of. Liquidity, trading volume. Ensure the ETF has sufficient trading volume so you can buy and sell shares easily without significantly impacting the price. Understand the underlying index. Asterisk, before investing in an index ETF, make sure you understand what that index represents and its performance characteristics. Example scenario: building a simple portfolio with ETFs, money simulation. Let's say you have $10,000 to invest and want a diversified portfolio using ETFs. Here's one possible approach: Vanguard S&P 500 ETF, VOO, $5,000. This provides broad exposure to the US stock market. iShares Core US Aggregate Bond ETF, AGG, $3,000. This adds a bond component for stability and diversification. Invesco QQQ Trust, QQQ, $2,000. This provides exposure to the technology sector, which has historically shown strong growth. iShares Global XUS ETF, IXUS, $1,000, diversifies your portfolio beyond the US market. Disclaimer: asterisk, this is a simplified example for illustrative purposes only and does not constitute financial advice. Your actual investment decisions should be based on your own research, risk tolerance, and consultation with a qualified financial advisor. Resources to learn more: Vanguard ETFs website asterisk https investor.vanguard.com/ETFs. iShares ETFs website asterisk https www.ishares.com/ ETF.com asterisk https www.etf.com/. A great resource for ETF research and analysis. Investing in ETFs can be a fantastic way to build wealth over the long term, offering diversification, low costs, and liquidity. By understanding how they work and the different types available, you'll be well on your way to making informed investment decisions. Don't forget to like this video and subscribe to AI Money Lab for more easy-to-understand financial content.